Welcome to This Explainer. Today, we're unpacking a truly fascinating week in the markets, one that's being entirely defined by an extreme, unprecedented clash. On one side, we have explosive geopolitical chaos, and on the other, just booming corporate profits. It's essentially a massive tug of war, and it's completely defining the summer of 2026.
So here is our roadmap for today. We're going to start with that macro contradiction, look at some leveraged oil and healthcare case studies, check in on crypto's big institutional leap, and then prep for an absolutely massive financial week ahead.
All right, kicking things off with Section 1, a market in contradiction, geopolitics versus corporate earnings.
Now, on one hand, the source notes a staggering 30% spike in oil prices over just a single month. And this isn't happening in a vacuum. It's being driven by 13 consecutive nights of U.S. strikes on Iran, which, by the way, is the longest sustained campaign of its kind since the Iraq War. Combine that reality with Houthi forces attacking Saudi oil tankers in the Red Sea, and you have a geopolitical environment that is genuinely dangerous. It's driving energy markets into an absolute frenzy.
But here's the wild part. In a totally bizarre twist, right next to that dangerous reality, corporate America is showing extraordinary health. Companies are posting a 37.9% blended earnings growth rate for Q2. That is the highest growth rate since Q3 of 2021, with an 88% beat rate among early reporters, including some really massive numbers from Alphabet and the major banks. The U.S. economy is signaling that despite the global chaos, American businesses are still incredibly resilient and profitable. Both of these extreme stories are playing out at the exact same time.
Moving right along to Section 2, the leveraged oil trade, and how we're validating the escalation thesis.
Look at how market analysts are viewing this Middle East supply disruption now. It's no longer just some distant tail risk, it's actually becoming the base case. Just read that quote from RBC Capital Markets warning of a $146 worst-case scenario. When you factor in aggressive projections like Goldman Sachs targeting $120 Brent crude by Q4, and the fact that both the Strait of Hormuz and the Red Sea are under simultaneous threat, we're talking about a potential disruption to roughly 35 to 40% of the entire global oil trade. It's a huge deal.
So to navigate this extreme volatility, the source outlines some very strict risk management rules for those tracking USOU, which is a 3x leveraged oil ETF. Because leveraged products suffer from volatility decay, they can literally eat your portfolio alive if you aren't careful. That's exactly why these rules are so unforgiving. A maximum 1 to 2% position size, a strict 30-day time limit, and a hard 15% stop loss right from entry. Having these defined exit strategies is what separates disciplined, calculated trades from reckless gambles in a market this choppy.
Okay, Section 3, United Health's massive turnaround. Let's look at how they reversed their Q1 disaster.
This brilliantly illustrates the turnaround. Back in Q1, United Health was in a total tailspin because of a blown-out medical cost ratio of 90.4%. But look at Q2. They fixed that problematic metric, bringing it back down to a two-year low of 86.7%. And as a result, they absolutely crushed the Q2 EPS consensus by a massive 30%, coming in at $6.38 per share. It is a textbook example of data definitively confirming a corporate recovery in just a single quarter.
But we always have to balance a strong bull case against a very real bear case here. The bull case is obviously fueled by their high-margin Optum division growing at 29%, generating a staggering $11.1 billion in operating cash flow and fixing that medical cost ratio. However, on the other side of the ledger, there's an active, highly unpredictable Department of Justice civil and criminal investigation into their Medicare billing practices. The source neutrally points out that while the fundamentals are strong right now, legal overhangs like this can represent a persistent daily risk to your portfolio.
Right, let's jump to Section 4. Crypto goes mainstream. We are watching the shift from alternative to embedded.
We are seeing real, undeniable structural allocation happening globally. First up, there's persistent wealth management demand, with Morgan Stanley seeing massive $400 million inflows into a regulated Bitcoin trust. Second, and get this, Amazon is dropping $500,000 a year on a crypto ecosystem lead. That heavily implies direct payment integration is coming across their vast platforms. And third, Russia is establishing formal regulatory frameworks for crypto trade settlement to help navigate Western sanctions. When traditional banks, global tech giants, and sovereign nations are all building blockchain infrastructure at the same time, it shows crypto is just becoming standard financial plumbing.
Meanwhile, the source points out that major networks like Solana are holding steady as they await Declarity Act. With an August 7 deadline coming up fast, this pending U.S. legislation could officially classify Solana as a commodity. Now, why does commodity classification even matter? Because it's the exact legal key required to unlock serious, massive institutional capital deployment into these networks.
And that brings us to Section 5, the most important week, otherwise known as the ultimate stress test.
Guys, this week is basically the Super Bowl, World Series, and NBA Finals of the 2026 investment calendar all packed into 3 days. The calendar is just relentless. It accelerates starting Wednesday with a critical FOMC rate decision and a press conference by Fed Chair Wirtz, going straight into earnings from AI bellwethers Meta and Microsoft right after the bell. Then, massive Q2 GDP and PCE inflation data drop simultaneously on Thursday morning, followed by Amazon and Apple earnings. Finally, Friday brings the Employment Cost Index, which is a crucial wage inflation metric. It's an incredibly data-dense stretch that's absolutely going to dictate the market's tone for months.
When Thursday's GDP print drops, all eyes are going to be glued to that 2.5% threshold. Q1 came in at 2.1%, and the consensus for Q2 is sitting at 2.3%. If we see a consensus beat pushing above that 2.5 line, it would signal undeniable economic strength. And that would be remarkable, especially given the lingering macro headwinds and the high interest rate environment we're currently navigating.
Ultimately, what you should take away from this explainer is a profound question, one that's going to define the rest of 2026. With all the data we've covered today, can this incredible wave of corporate profitability actually continue to offset the immense risks of a rapidly escalating global conflict? It's a really high-stakes balancing act between resilient companies and a chaotic world. And this week's massive data dump is going to give us our very first real clues to the answer.